My name is Jim Weisel, Professor of Accountancy at Georgia Gwinnett College. In this video, we are going to discuss how to measure, recognize, and disclose long-term notes payable. Specifically, the two types of long-term notes payable that we're going to discuss here are traditional interest-bearing notes payable as well as non-interest-bearing notes payable. So let's take an example of an interest-bearing note payable. We have XYZ Company on January 1st of 2013 signed a 3-year $50,000 note with a 5% interest rate. Interest is payable annually at each December 31st. So what's going to happen here in terms of cash flows is the company is going to receive some cash flows now, January 1st, 2013, and then on December 31st of 2013, 2014, and 2015, they will be making interest payments. So interest is payable annually. This note in particular states that interest is payable annually. And so we need to make sure that we understand how to account for all of those cash flows. And then December 31st, 2015, that's 3 years from now, is when the note will mature. And so on that interest payment date, not only will XYZ Company write their final interest check, but they will also repay the principal amount. Now what we're going to focus on in this example is just what happens in 2013. So the first thing is January 1st, we simply sign a note payable that has a face value of $50,000 and we collect cash or other assets of $50,000. So the transaction there is pretty straightforward. We debit cash for $50,000, credit notes payable for $50,000, and that's it. That's all that happens on January 1st. On December 31st, we have another cash flow, specifically the interest that is payable on that note. And so we're going to follow the same convention that we use all the time to determine interest expense. And that convention is to take the face value of the note multiplied by the appropriate interest rate multiplied by the portion of a year for which the note has been outstanding. So I have a note that has a face value of $50,000. The interest rate is 5%, and I'm going to multiply that by the portion of a year for which the note has been outstanding. Well, the note was issued January 1st. It is now December 31st. That is simply 12/12ths of a year. So realistically, we don't have to throw that calculation in there, but just remember that's how I want you to think about making the calculations. You want to make sure that you stop and ask yourself, for how long has this note been outstanding? For example, if this note had been issued on February 1st instead of January 1st, then the note would have been outstanding as of December 31st for 11/12ths of a year. In this particular case, the note's been outstanding for the entire year, and so I can multiply this thing by 12/12ths, but I'll still end up with $2,500 of interest expense that needs to be recorded this year. And that is going to be paid this year as well. And so the journal entry on December 31st is very simply to debit interest expense for $2,500 and credit cash for $2,500. That's exactly what's happening. There's no interest payable here. We're not accruing interest. We are actually paying for the interest. And so we debit the expense account and credit the cash account. Now, what happens with respect to the disclosure? Well, the balance sheet as of December 31st, 2013 would show a long-term note payable with a balance of $50,000. That's the credit balance in the note payable account, and that's the only liability or payable that we had to deal with in this particular transaction. And so the balance of notes payable is $50,000. That's exactly what would show up on the balance sheet. It's going to show up as a long-term note payable rather than a current note payable because at the end of 2013, the note has been outstanding for 1 year. It won't be paid for another 2 years. It's going to be outstanding for 2 more years. And so that's why it's a long-term note payable. The income statement would also include the $2,500 of interest expense. In this course, we are emphasizing what happens on the balance sheet, but certainly the income statement is impacted here as well. And so we would have a $2,500 interest expense as a part of the income statement on this particular note. Now let's move on to an example of a non-interest bearing note, or what is sometimes known as a discounted note payable. So we're going to take the same company and the same basic sort of financial arrangement. January 1st, 2013, XYZ company signed a 3-year $50,000 note and received $43,000 of cash for it. Notice that non-interest bearing notes are just that. They don't have interest explicitly stated on the contract, but it is rather implied. We are borrowing $43,000 today, and then we are going to repay $50,000 3 years from now. Notice here that we are not going to have any annual cash flows. There's no interest payment that's required at the end of each year, unlike the previous example. This is just very simply $43,000 of cash coming in, and then $50,000 of cash going out 3 years from now. So the journal entry on January 1st is obviously our first step, and that's relatively straightforward. We just simply debit cash and credit notes payable for $43,000. Now, some companies will split up the face value of the note and use a discount on notes payable, a contra liability account, similar to a discount on bonds payable. But most firms will not do that. It adds complexity and is relatively unnecessary. So we just simply, in this case, keep things simple. Debit cash for $43,000, credit note payable for $43,000. Now, on December 31st, even though there is no cash flow occurring, the note has been outstanding, and notes have interest associated with them. Whether it's implied or explicitly stated, either way, there's a cost of borrowing money. And we need to make sure that with non-interest bearing notes that we get the correct amount of interest expense recorded on the financial statements. And so what we do with a non-interest bearing note is we have to figure out what the implied interest rate is, or we need to, at the very least, figure out how much interest expense should be assigned to this particular note. And so the way that we do that is to work with the implied interest rate. We need to figure out what the implied interest rate is, and from that we can determine our interest expense. So let me bring up my financial calculator here, and I'm going to again make sure that my time value of money registry is cleared out. Interest rate per year, or payments per year, or compounding periods per year is just 1. I need to make sure that I get that set up correctly. Now I can figure out what the implied interest rate here is on this note. We have $50,000 of cash that will go out in the future, so I put that in as a negative. I have $43,000 of cash coming in, that's the present value today. There is no periodic payment, so I just leave that alone. There's a cash inflow today, that's the present value as a positive $43,000, and then the negative $50,000 future value or face value of the note. Okay, that's straightforward enough. The number of periods for which this note will be outstanding is 3 years. So n is equal to 3, and then I can compute my interest rate per year, and that's where I get the 5.16. If I borrow $43,000 today and repay $50,000 3 years from now, that implies an interest rate of 5.16% annually. Okay, so now that I have the implied interest rate, that gives me the information I need to determine the interest expense. And here's where things get a little bit different. What I have to do to compute the interest expense is take that implied interest rate, that 5.16%, and multiply it by the amount of loan that is outstanding currently, the book value of the loan. That's $43,000. I have borrowed $43,000. I have the use of $43,000, and I am going to be paying 5.16% interest on that. So I take 5.16. To decimalize that, I'll just go ahead and divide it by 100 and then multiply it by the $43,000. So I'm taking my $43,000, that's the book value of the note, multiplying it by the appropriate interest rate, and then once again, technically I would multiply that by the portion of a year for which the note has been outstanding. But again, in this particular case, the note has been outstanding for an entire year. And so I have $2,200 or $2,217 of interest expense that needs to be recorded. That interest expense just simply gets added to the note payable balance. That's one of the differences between a discounted note and an interest-bearing note. In an interest-bearing note, I'll have a separate account to keep track of the interest payable. Here, it just simply gets added to the note payable balance directly. And so what's going to happen is over the 3-year period of time, I'm going to be recognizing 3 of these interest expense calculations. Each one is going to be a slightly different amount, but eventually at the end of the 3rd year, the balance in my note payable account would be $50,000. As it is here at the end of 2013, the balance sheet is going to show a balance of long-term notes payable of $45,217. That's the original credit to notes payable plus the credit to notes payable to recognize the interest expense. That adds up to $45,217. The income statement is also going to show a $2,217 interest expense. So again, we're focusing on the balance sheet. That's the liability element here. And so the balance in notes payable is $45,217. And that's how we would recognize, at least in the first year, the discounted note payable. The key here that you have to pay attention to is to determine the interest expense. We take the book value of the note, multiply it by the implied interest rate, and then multiply it by the portion of year for which the note has been outstanding. Now, let's see what happens with the analysis. We've talked about measurement, we've talked about recognition, we've handled disclosure, and now I want to make a short mention of analysis. So what's the effect of issuing debt? And one of the ways that we can measure or assess the effect of issuing debt is by looking at the debt-to-asset ratio. The debt-to-asset ratio is one of the very common measures of financial status of an organization, and it essentially measures the proportion of assets that are financed through debt. When we look at the balance sheet, right, assets equals liabilities plus shareholders' equity, we can see in this particular example we have a company that has $500,000 in assets, and that's financed by $200,000 in liabilities and $300,000 in shareholders' equity. 200 plus 300 adds up to 500. So our balance sheet balances, and we can also determine that our debt-to-asset ratio here is 40%. $200,000 of liabilities divided by $500,000 of assets is a 40% debt-to-asset ratio. So 40% of our assets are financed through debt, which would imply the other 60% of our assets are financed through shareholders' equity. Now, what happens if this company issues, say, a $50,000 note? Well, we're going to add $50,000 to the asset side of the balance sheet by way of debiting cash, most likely, and we're going to add $50,000 to liabilities by recognizing the note payable, crediting notes payable. Both of those increase the asset side of the balance sheet and increase the liability side of the balance sheet. So The balance sheet is going to be adjusted or to recognize that issuance. We now have $550,000 in assets and $250,000 in liabilities. Shareholders' equity was not affected by the issuance of debt. But notice here, and this is the key, this is where the analysis comes in. Notice here that proportionately our liabilities have increased more than our assets. $50,000 more liabilities added to $200,000 is a greater impact than adding $50,000 to $500,000. So if we recompute now the debt to asset ratio, it's going to be 250 divided by 550, and our debt to asset ratio has actually increased. So even though each side of the balance sheet increased by the same dollar amount, $50,000 on both sides of the equation, proportionately that $50,000 affected liabilities more than it affected assets. And so now our debt to asset ratio is up to 45%. This is what's sometimes referred to as financial leverage, the extent to which we are using other people's money, the extent to which we are using external sources of financing. And so a higher debt to asset ratio means that we are more highly leveraged. There are some potentially good things related to that, but there are some potential risks associated with that as well. As the debt to asset ratio increases, generally firms will find that the cost of additional borrowing is going to go up. A higher debt to asset ratio is perceived to be associated with higher risk, particularly for the creditors of the firm. And so as the debt to asset ratio goes up, we'll typically see that the cost, the interest rates associated with any future liabilities will be higher than what they were previously. So that's a quick review of what happens with respect to analysis and specifically the effect of issuing debt for a particular company.